Video, we're going to be taking a deeper dive into the Federal Reserve System and take a look at what it does in terms of monetary policy. So, the functions of the Federal Reserve System are to provide financial services. So, it's the bank for banks and for the federal government. It's where the U.S. government parks all of its money and where banks can borrow and lend money to each other. It also supervises and regulates banks. It maintains stability of the financial system. It provides liquidity into financial institutions to ensure their safety. So if commercial banks need money, they can provide it to them. And it conducts monetary policy. And this satisfies the dual mandate of the Federal Reserve System, which is to have full employment and stable inflation. So notice stable inflation, not no inflation, stable inflation. So this is the dual mandate of the Federal Reserve System and basically what it has to try to balance. So let's take a focus on monetary policy because that's going to be the main thing that you have to know for this course. There's three things in terms of monetary policy, at least three according to the College Board. We will go over what the Fed actually does later on, but for now, in terms of what you have to know for the AP test, it's these three things. The monetary policy deals with the reserve requirement, the discount rate, and open market operations. The reserve requirement is the amount of money that banks have to keep in their vaults or keep on reserve at the Fed. So if they don't maintain that reserve ratio, on average at least, they face penalties. To help banks do this, they can borrow from the federal funds market, which, despite the name, is banks borrowing from other banks based on the reserves at the Fed. So banks can keep their money on reserve at the Fed and lend it out to other banks, usually on a short-term basis. That's the federal funds market. The federal funds rate is just the interest rate at which the federal funds market trades. Now, if you have changes in the reserve requirement, you have to think a lower reserve ratio increases the money supply and the opposite. Because if you think of that multiplier effect, if you have a lower reserve ratio, that means more money can be lent out. So lower reserve ratio, increased money supply. Higher reserve ratio, decreased money supply. As of right now, when I'm making this video, there is no reserve requirement. In theory, they could have an infinite change to the money supply. However, most banks aren't going to do that. They're going to keep, not most, all banks aren't going to do that. They're going to keep money at reserve so that they can service their customers better. The discount rate is sort of the last stand for banks. The discount rate is the rate of interest the Fed charges through the discount window. So usually it's set a bit above the federal funds rate to basically coax banks into borrowing from each other first. So this is the lender of last resort. So if banks are really in trouble, they can ask the Fed to borrow money, and it's going to cost them. So the spread is the difference between the discount rate and the federal funds rate. And altering this spread or making the discount rate higher is going to alter the money supply by allowing by changing up banks' risk assessment. So they might get closer and closer and closer to the reserve ratio if the spread isn't that large. This allows them to lend more and increasing the real money multiplier. If, however, they increase the spread, that means there's bigger risk involved. So banks aren't going to lend quite as much, not getting to that reserve ratio or as close to that reserve ratio because they don't want to hit that. So they would have to do the discount rate. The big one that the AP test wants you to know is open market operations. So this is when the Fed is buying or selling U.S. Treasury bills or T-bills to and from commercial banks. Now, T-bills are essentially bonds that people buy for, or they're government bonds. So it's people, individuals, and businesses and things like that loaning the federal government money. So the Fed will in turn buy these T-bills or sell them. If they buy the T-bills, it increases the monetary base. If they sell T-bills, it decreases the monetary base by reducing overall reserves. And this is the agent that starts the money multiplier into action. So we're going to take a look at how that occurs on the next two slides. So if you look at this T account, which, yes, you have to know how to do this, and it's going to be annoying. And no, it really shouldn't be covered by the AP test anymore, but it is. So we're going to learn it. So when you're looking at this, you'll notice there's three sort of sets of things going on. You have assets on the left-hand side, liabilities on the right, and the three different agents here are the Fed, banks, and bank customers. Each have their own sets of assets and liabilities. For the Fed, it has Treasury securities being its assets. This is what it is earning money on. Its liabilities are going to be the reserve accounts of banks and Federal Reserve notes because that's what they have to pay back. Federal Reserve notes is just currency. For banks, their assets are going to be their reserve accounts because that's something that can pay out to them. Federal Reserve notes, once again, currency. Loans are assets to banks because they are going to be earning them money. Liabilities for banks are checkable deposits because that is money they owe back to their bank customers, and whatever worth they owe to their stockholders. Bank customers are going to see their checkable deposits be assets because it's, once again, something that they own. Federal Reserve notes, once again, currency, and Treasury securities, money that is loaned out to the government. Loans for bank customers are going to be a liability because they have to pay that back. Now, there's a few things you might notice when looking at this T account. You'll notice that the loans that bank customers have should be equal to the loans that banks lend out. The checkable deposits banks have should be equal to the checkable deposits that bank customers have put in. The Federal Reserve notes that the Fed has put out there should be equal to the Federal Reserve notes in banks and the Federal Reserve notes held on by bank customers. So, using this as sort of our baseline. Oh, and reserve accounts of banks are going to be the same for the Fed and for the banks because obviously the banks keep them on reserve at the Fed. So these are all the connections that you need to make. All of these need to be lined up. Now, let's take a look at how it plays out. Oh, before I forget, the money supply. When we're talking the money supply, it is the combination, and this is M1 money supply, it's the combination of your checkable deposits and your Federal Reserve notes in circulation. So in other words, with bank customers. So $300 plus $53. Your money supply here is $353. Now let's see what happens when there is a change. So when the Fed is going to buy $10 worth of Treasury securities. So if you look back and forth between these two slides, you should see the difference. The Fed buys $10 of securities, upping this from 83 to 93. Where did they buy them from? They bought them from bank customers. So the bank customers lose $10 in Treasury securities. So that is going to now start the money multiplier in action. So what's going to happen is that $10 in Treasury securities that the Fed purchased from the bank customers, that money is going to bounce around and eventually end up in the reserve accounts of banks. So you're seeing that $10 added in the reserve accounts of banks. Now it multiplies out. So once that multiplies out, the money multiplier is 1 divided by the reserve ratio. So if the money multiplier is 1 divided by the reserve ratio, and the reserve ratio is 10%, then you should see that $10 times the multiplier, which is 1 over 1/10, or 10. So $10 change times 10, your change in checkable deposits will be $100. So you add 100 there. That means that banks can now loan out 90% of that. So banks will loan out an extra $90. The change in checkable deposits overall should equal the change up here, as we saw that play out before. And the amount of loans should be equal on both sides as well. Now we add together our money supply. Our Federal Reserve notes, our currency held by bank customers, never changed. Our checkable deposits, however, did change. So we're now at $400 plus $53. Our total money supply has gone up to $453, which fits with our change from before, because it was $353, so a $10 change times the multiplier should equal out to 100, which we see there. And that's it.